Welcome to the deep dive. We're here to unpack complex topics and really extract the most important bits of knowledge for you.
That's right.
Today, we're diving headfirst into, well, a truly high-stakes scientific gamble.
Hmm.
Imagine if we could fundamentally re-engineer the human immune system. Like, actually cure diseases like type 1 diabetes, lupus, and do it without needing lifelong, debilitating immunosuppression drugs.
It sounds almost like science fiction, doesn't it?
Yeah.
That's the really audacious vision behind Sana Biotechnology.
Exactly. But here's the thing. It's what you'd call a classic binary investment, meaning
Right.
there's this huge, immense upside if their revolutionary science actually works. But there's also the very real potential for, well, a complete loss of capital if it doesn't.
It really is a profound promise, but also a monumental challenge all rolled into one. As we're about to get into, Sana isn't just, trying to treat symptoms. They're really aiming for a functional cure.
Absolutely. So our mission today is simple. Give you the shortcut to being well-informed about Sana Biotechnology. That's ticker symbol SANA. It closed at $4.63 on July 18th, 2025.
And we're going to explore whether they've got the tech, the leadership, and crucially, the financial strength to turn this incredible vision into a commercial reality.
Right. Let's start by really understanding their foundational business. Okay, let's kick off with Chapter 1, the business of engineering cells. So Sana's really bold goal here is solving immune rejection. That's the big hurdle. If they clear it, it could unlock truly off-the-shelf cell therapies.
But the first thing you absolutely need to know is that Sana is pre-revenue, clinical stage.
Meaning no product sales, no income right now.
Exactly. Their entire business model, it hinges on raising capital. They got over $588 million in their 2021 IPO, which is pretty substantial.
Right.
And then another $119 million facility just this past May.
So straight away, that tells you this is high risk, high reward. Any value right now comes purely from the future probability of their science actually working out.
Hmm. And building on that, Sana's scientific backbone, it really rests on two very sophisticated cell engineering platforms. The first is ex vivo cell engineering.
Okay, what's that involve?
Think of it like taking cells out of the body, could be from a donor, could be
Yeah.
from the patient themselves, genetically tweaking them in the lab, and then putting them back.
Right.
This is the approach that underpins their most advanced programs, the ones currently in clinical trials.
And then there's the more futuristic sounding one.
Precisely. That's
Okay.
in vivo cell engineering. The vision here is, frankly, transformative.
How so?
They want to deliver genetic payloads directly into cells inside the body to reprogram them right there on site.
Wow. So like turning the patient's own body into a little cure manufacturing factory.
You got it. It's potentially groundbreaking stuff.
So, okay, what does this cutting edge science actually mean for their pipeline? What products are we looking at?
Right now, their key products are in phase 1 clinical trials. So early stages, but targeting some really big diseases. First up, SC4521 UK421 for type 1 diabetes. The aim here is a functional cure. They transplant insulin-producing pancreatic islet cells.
And the key innovation here is their hypoimmune tech, right?
Exactly. That's the secret sauce. And what's really generated buzz recently is the 6-month clinical data from the first patient in the UP421 trial.
What does it show?
It showed the transplanted cells survived and produced insulin, all without the patient needing immunosuppression.
Okay, that sounds like a pretty big deal. No immunosuppression is huge.
It's a massive positive catalyst. It's a first real sign their core tech might actually work in humans.
All right. What else is in the pipeline?
Then there's SC291 for autoimmune diseases. This is an allogeneic KRAT cell therapy.
Allogeneic meaning from a donor.
Right, not the patient's own cells. It targets something called CD19, aiming to treat conditions like lupus. And Sana's actually increased their strategic focus here on autoimmune disorders lately.
Interesting shift. And there was a third one.
Yes, SC262 for oncology. Another allogeneic CAR-T, this one targets CD22.
Okay, CD19, CD22. What are those?
Think of them like specific identification tags on certain types of B cells, which could become cancerous. SC262 is for B-cell cancers that have come back after earlier therapies targeting CD19. So it's hitting a different target on the cancer cell.
Got it. So how does Sarana fit into the bigger market picture?
Well, with a market cap around $1.04 billion, they're definitely a small cap company.
High growth potential, but higher risk too.
Precisely. The entire valuation right now is basically a bet on this pipeline succeeding. But even though they're small, they're targeting potentially massive markets, right? Oncology, diabetes, autoimmune. These are huge areas.
And this leads us back to their main value proposition, doesn't it? That off-the-shelf cure idea, enabled by their hypoimmune platform, or HIP.
That's the core concept. Genetically engineered donor cells so they're, like, invisible to the patient's immune system.
So they don't get rejected.
Exactly. And if they don't get rejected, you don't need those lifelong immunosuppressive drugs, which have their own serious side effects.
Okay, the significance of that, if it works.
Oh, it would be monumental. A huge breakthrough. It enables scalable, truly off-the-shelf cell therapies.
Meaning lower costs, better safety, more patients can actually get these treatments.
Absolutely. And that recent UP421 data, that positive signal, it's the first human proof of concept for this HIP technology. It really validates that their core tech moat, their competitive advantage, it might actually be real and effective. That sets them apart from a lot of competitors still in the preclinical stage.
Okay, stepping back a bit, what about the overall market they're playing in?
Well, they're right in the middle of the cell and gene therapy market, which is growing incredibly fast.
How fast?
Projections show it surging from about $25 billion this year, 2025, to potentially $117.5 billion by 2034. That's an 18.7% compound annual growth rate.
Wow, okay, so SANA's positioned right at a massive growth trend.
Definitely. But the competitive landscape is fierce, very crowded.
Who are they up against?
You've got the big pharmaceutical giants, Eli Lilly, Johnson & Johnson, Novartis, then established biotech leaders like Moderna, Vertex Pharmaceuticals, and even other specialized cell therapy players, companies like Scholar Rock, Viking Therapeutics.
So it's like a small, innovative speedboat trying to navigate waters filled with battleships and other fast boats.
That's a pretty good analogy, yeah.
And regulations, biotech is always heavily regulated.
Extremely. Especially by the FDA's division called CBER Center for Biologics Evaluation and Research. They handle cell and gene therapies. The process is long, it's rigorous, it's incredibly expensive.
Which sounds like a big hurdle.
It is, but, if you manage to clear it, it also creates a pretty strong protective barrier, a moat, around your business.
Right. What about other barriers to entry?
They are exceptionally high in this field. First, R&D costs. We're talking potentially over $2 billion to get a single drug to market.
$2 billion? Wow.
Yeah. Then there's that complex, lengthy regulatory pathway we just mentioned. You need rock-solid intellectual property protection. And very importantly, you need highly specialized, very expensive manufacturing facilities that meet GMP standards.
Yeah.
Good manufacturing practices. Extremely strict quality control. Setting that up is a huge barrier for newcomers. All these factors together create a pretty significant moat for companies already established or well-funded.
Okay, that gives us a good picture of the business landscape. Let's switch gears now and look at the people running the show. Chapter 2, Management Evaluation.
Right. Starting at the top, the CEO is Dr. Steve Harr.
And his background seems pretty relevant.
Very relevant. He was the CFO and head of corporate development at Juno Therapeutics.
Juno. Wasn't that the company Celgene bought for like $9 billion?
That's the one.
Yeah.
So he has experience with a major success story in this exact field.
Yeah.
And the broader senior leadership team, they're also veterans from top-tier biotech and pharma firms, places like Vertex, Johnson & Johnson. So on paper, very strong pedigree.
Okay, on paper. What about their actual performance at SANA?
Well, that's where it gets a bit more nuanced. Since the IPO, they've definitely faced some significant operational headwinds. Meaning they've had to make some tough calls, sort of crisis response decisions. There was a 15% workforce reduction back in November 2022.
Okay.
And then another, even larger cut, 29% in October 2024.
Ouch. 2 rounds of layoffs.
Yeah. And these cuts came alongside strategic pivots, basically narrowing their focus. Now, management frames these as prudent, necessary adjustments.
About that.
But the company's stock price is down over 80% from its peak.
80%. That's huge.
It is. So there's clearly a disconnect somewhere between that impressive leadership pedigree and the actual stock performance. It might suggest they were maybe a bit overambitious initially, expanding too quickly after the IPO, and now they're having to pull back and refocus.
That makes sense. It raises questions, though. How transparent have they been?
They use the standard communication channels, press releases, SEC filings.
Right.
But there was a pretty significant red flag here.
Which is?
Class action lawsuits. Initiated this year, 2025, by shareholders.
Oh, boy. What's the allegation?
The core claim is that leadership made false or misleading statements. Specifically, that they allegedly concealed the fact they didn't have enough funds to maintain operations as planned.
That's serious. It definitely raises questions about candor, doesn't it? It creates a kind of reputational cloud.
It absolutely does. It's something potential investors really need to be aware of.
Okay. What about how they allocate capital since they're pre-revenue?
Right, their capital allocation is almost entirely focused on one thing, funding R&D. Research and development. They spent about $217.6 million on R&D in fiscal year 2024.
A huge chunk of change.
It is. They've also shown they're willing to make strategic acquisitions, like buying a company called Scene Corp to boost their tech capabilities.
And things like share buybacks or dividends.
Non-existent,
Yeah.
which is completely standard and, frankly, prudent for a company at this stage. They need every dollar for research.
Makes sense. So what about return on invested capital, ROIC? I assume it's not great.
It's deeply negative, somewhere between minus 34% and minus 58% on a trailing 12-month basis.
That sounds terrible, but you're saying it's expected.
Exactly. For a company like Sana, a negative ROIC isn't necessarily a sign of distress yet. It's just a direct reflection of this intense investment phase they're in. It basically quantifies the cash burn relative to the capital they've brought in. It highlights how fast they're consuming cash and underscores that urgent need for their research to eventually, hopefully, generate positive returns.
Got it. Okay, that sets the stage nicely for a deeper dive into the numbers. Let's move to Chapter 3, Financial Analysis. And we're using that closing price of $4.63 from July 18th, 2025 as our reference.
Right, so key metrics.
Right.
Market cap, as we said, about $1.04 billion. Small cap territory.
Higher potential growth, higher volatility, higher risk. Check.
Revenue growth trends. Well, it's easy. Zero revenue. Valuation is all about the future.
No profit margins then. What about net loss?
Significant. It was $266.8 million for the full fiscal year 2024. That reflects those heavy R&D costs and overhead.
And free cash flow, also negative, I assume.
Consistently and significantly negative, yes. The cash burn rate was about minus $256.6 million for FY 2024. But interestingly, it moderated a bit in the first quarter of 2025 to minus $48.8 million.
Likely due to those cost-cutting measures and layoffs we talked about.
Precisely. They're trying to stretch the runway.
So for a company like this, financial stability isn't about profits, it's about runway. How long can they keep the lights on?
Exactly. It's about having enough cash to fund operations until, hopefully, a product gets to market.
And earnings consistency.
Consistently negative net losses since they started.
Yeah.
And that's expected to continue for the foreseeable future.
What about debt?
Their debt-to-equity ratio is actually relatively low, around 0.44, and most of their liabilities are things like operating leases for facilities, not traditional bank debt. So from a leverage perspective, the balance sheet looks pretty healthy.
Okay, that's a positive. And liquidity, short-term health.
That looks strong, too. Their current ratio is 3.40, meaning they have $3.40 in current assets for every $1 in current liabilities.
Yeah.
So plenty of short-term cushion to cover immediate obligations. For a cash-burning company, that strong current ratio is critical.
Right. And dividends, as we said, none expected.
Correct. Now, if you look at the trend in their cash and equivalents over the last few years, it tells a story.
Let's hear it.
Back in 2022, they had about $502 million. By the end of Q1 2025, that was down to about $105 million.
Wow, that's a steep drop. Nearly 80% of their cash gone in just over 2 years.
It really underscores the diminishing reserves. The clock is definitely ticking.
Okay, so how do you even value a company like this? Traditional metrics like PE are useless without earnings.
Right. Price to book is about 4.99, but that's not very helpful either. For a biotech, the real value isn't in physical assets on the books. It's in the intangible stuff, the intellectual property, the potential of that pipeline.
So you have to use different tools.
Exactly. We turn to intrinsic valuation, typically using a discounted cash flow or DCF model. But, and this is a big but, for a pre-revenue company like Sana, it's highly speculative.
Why so speculative?
Because you have to make a lot of assumptions. You need to estimate the total market size, peak sales, if the drug works, how much market share they might capture, and crucially, the probability of success for each step in the clinical trials.
That probability sounds like the trickiest part.
It absolutely is.
So what do these speculative educational DCF models suggest for Sana's value?
The estimated range comes out somewhere between, say, $4 and $7 per share.
Okay, and the current share price is $4.63, so right smack in the middle of that range.
Exactly. It reflects that speculative nature.
What are the key assumptions driving that range, the ones that are most sensitive?
Okay, 3 big ones. First, growth rate and peak sales. These are derived from the lead drug potential. For SC451 in diabetes, the risk-adjusted peak sales projection might be around $1.9 billion. Big number, but heavily risk-adjusted.
Risk-adjusted based on?
Based on the probability of success. That's the second and most critical input. For SE451, that probability of getting all the way to market is estimated at just 20%.
Only 20%. Wow.
Yeah, it's roughly the industry average for something this innovative at this early stage. A small change in that percentage has a massive impact on the calculated value. It really highlights the make-or-break nature of the clinical trials.
Okay, and the third key assumption.
The discount rate, or WACC, weighted average cost of capital. Because of the high risk, this has to be high, likely in the 12% to 15% range.
And that's based on?
Based on things like the current 10-year U.S. Treasury yield, maybe around 4.5%, plus a standard equity risk premium of maybe 5.5%, and then adjusted upwards for SANA's specific risk, reflected in its high stock beta of 1.86.
Beta meaning volatility compared to the market.
Right. A beta 1.86 suggests the stock is about 86% more volatile than the overall market. More risk demands a higher discount rate, which lowers the present value of those potential future billions.
So wrapping up the financials, it really sounds like a race against time, doesn't it?
That's the perfect way to put it. Management themselves have guided a cash runway into 2026.
Okay, so maybe a year and a half, roughly?
Roughly. With that quarterly cash burn around $49 million, getting compelling clinical data readouts in 2025 isn't just about scientific progress.
It's about survival, needing good news to raise more money.
Exactly. They're critical financing events. It's not just a balance sheet item. It's the ticking heart of SANA's gamble.
Okay, let's broaden our view now and look at Chapter 4, Market Sentiment. How is the market feeling about SANA right now?
Well, if you look at Wall Street analysts, the consensus is largely a strong buy. So, on the surface, pretty optimistic for the next 12 months.
But I sense a but coming.
There's always a but with biotech. Hidden within that consensus is significant uncertainty. Just look at the range of 12-month price targets.
What's the spread?
It goes from a low of $5 all the way up to $15.75. The average is somewhere around $9.50, $10.
It's a huge gap, from basically current levels up to more than triple.
Exactly. It screams lack of agreement. It highlights that binary high-risk nature we keep talking about. Analysts are bullish, but they don't agree on how bullish, which reflects the underlying uncertainty.
What about recent news? How has that impacted sentiment?
The general media tone has been decidedly positive lately, and it's almost entirely driven by that promising June 2025 clinical data from the UP421 trial, the diabetes one.
The one showing insulin production without immunosuppression.
That's the one. It validated their core tech, sparked positive analyst actions, upgrades, favorable headlines. It was a real shot in the arm for sentiment.
Okay. Let's dig into some specific market indicators. What about short interest, people betting against the stock?
This is where it gets really interesting. Despite those bullish analyst ratings, there's a very large group betting against SANA.
How large?
The short interest is exceptionally high. About 37.5 million shares sold short. That represents nearly 28%, almost a third of the stock's available float.
Wow, 28%, that's massive.
It is. And the days to cover ratio is over 6. That means, based on average trading volume, it would take more than 6 full trading days for all those short sellers to buy back their shares.
So what does that tell us?
It signals substantial bearish sentiment, deep skepticism from a significant chunk of the market. But it also creates the potential for a short squeeze.
Explain that.
If good news hits or the stock price starts rising for any reason, those short sellers might rush to buy back shares to limit their losses. That buying pressure can itself drive the price up even faster, creating a squeeze.
Okay, so high short interest is a sign of risk, but also potential volatility to the upside. What about technical indicators like moving averages?
On that front, the picture looks much more bullish recently. The stock is trading significantly above both its 50-day simple moving average, which is around $2.72, and its 200-day simple moving average, around $2.70.
So it's broken well above its recent and longer-term price trends.
Exactly. That signals strong positive momentum, a bullish uptrend in the near term, and maybe, just maybe, a potential shift in the longer-term trend, possibly fueled by that positive data.
Interesting contrast, bearish short interest but bullish price momentum. Okay, let's look inside the company now. Chapter 5. Ownership structure. Who actually owns SANA?
A big chunk is held by institutional investors, over 65% of the outstanding shares.
Any names stand out?
Oh yeah, some very respected names, especially in the life sciences world. FMR LLC, that's Fidelity. Then you have Flagship Pioneering Inc.
Flagship. They were involved with Moderna, weren't they?
Co-founded Moderna, yes.
Yeah.
They're a premier life sciences venture capital firm, and then there's ARCH Venture Partners, another absolute top-tier life sciences VC.
Having specialist VCs like Flagship and ARCH involved, that feels significant.
It really is. Their presence provides a powerful endorsement, a level of validation that goes beyond just typical financial analysis. These guys know the science. You also see the usual large asset managers like BlackRock and Vanguard in there too.
What about insiders, management directors?
They own a meaningful stake too, about 8.85% of the shares.
Have they been buying or selling?
There have been some sales, which isn't unusual, but what's really noteworthy are some substantial purchases.
Oh, tell me more.
Most significantly, back in February 2024, entities linked to Director Robert Nelson, who's affiliated with ARCH Venture and RSH Venture Fund itself, made multi-million-dollar open market purchases.
Okay. At what price?
That's the key part. They bought at $5.50 per share.
$5.50. That's almost 19% higher than the $4.63 price we're using for this analysis.
Exactly. And crucially, they made these large purchases before that recent positive UP421 clinical data came out.
So the people with the most intimate knowledge of the company were buying significantly at a higher price, even before the best recent news hit.
It signals pretty strong conviction, doesn't it?
Yeah.
So overall, ownership is quite concentrated among the founders, those specialist VCs and large institutions. This can align interests towards long-term success, but concentration can also sometimes contribute to volatility.
Fascinating. Okay, let's try to pull all the potential dangers together now. Chapter 6, Risk Assessment. How about we use a SWOT analysis framework? Strengths, weaknesses, opportunities, threats.
Sounds good. Let's start with strengths. The biggest one has to be that revolutionary hypoimmune HIP platform, especially now with that early human proof of concept data.
Right. The core technology seems promising. What else?
The experienced leadership team, particularly CEO Steve Harr's track record with that $9 billion Juno acquisition, that counts for a lot.
Credibility, experience.
Definitely. Then there's that blue-chip investor base we just discussed. Flagship, RCH providing strong scientific and financial validation. And finally, the sheer size of the market opportunities they're targeting in diabetes, autoimmune, and cancer. Massive potential.
Okay, pretty compelling strengths. Now for the weaknesses. What are the big ones?
The most obvious is that they're pre-revenue and burning cash rapidly. Over $200 million in annual net losses. That makes them completely dependent on external financing, which is always risky.
The ticking clock we talked about.
Exactly. Second, the pipeline, while exciting, is still very early stage. Phase 1 mainly. That means an extremely high risk of clinical trial failure. Remember that 20% probability of success for the lead asset. That implies an 80% chance of failure.
Sobering statistic. Any other weaknesses?
Yes. That history of operational setbacks we mentioned earlier, the multiple rounds of layoffs, the strategic pivot since the IPO, it suggests maybe things haven't gone as smoothly as initially planned. And don't forget those pending class action lawsuits alleging lack of transparency.
Right, the reputational overhang. Okay, let's look at the upside potential beyond the pipeline itself. Opportunities.
Well, the biggest opportunity stems from the platform nature of their technology. If HIP is truly validated in one area, like diabetes,
It could potentially work for many other diseases?
precisely, it could open up a vast array of applications. Or they could license the HIP platform to other companies, creating entirely new revenue streams. Multiple avenues for value creation there.
Okay, what else?
They could absolutely become an acquisition target. If their tech continues to show promise, a large pharmaceutical company looking for innovative cell therapy assets might just scoop them up, like Celgene did with Juno.
A potential exit strategy for investors.
Could be. And fundamentally, they have the opportunity to address major unmet medical needs, offering potential functional cures where current treatments often just manage symptoms. That's a powerful driver.
All right, now for the scary part, the threats. What keeps Sana's management and its investors up at night?
Number one, without a doubt,
Yep.
clinical trial failure. It's the single greatest threat. A negative result in a key trial, especially for the HIP platform, could erase most of the company's market value almost overnight.
The binary risk personified. What else?
Intense competition. We talked about those pharma giants and other biotechs. Many have far deeper pockets and more resources than Sana.
Regulatory hurdles, too.
Absolutely. That long, costly, and uncertain path to FDA approval is always a major threat for any biotech, especially with novel technologies like cell therapy.
And the ever-present financing risk.
Yes. Survival hinges on their ability to raise more capital before the current runway runs out. If trial data disappoints, or if the broader market conditions turn sour, securing that funding could become incredibly difficult, or even impossible.
That touches on broader factors. How do things like inflation or interest rates impact a company like Sana?
They have a significant impact, maybe more than people realize. Inflation directly increases their costs, R&D supplies, administrative expenses, which accelerates that cash burn and shortens the runway.
And unlike a company selling products, they can't just raise prices to offset it.
Exactly. Plus, things like the Inflation Reduction Act, allowing Medicare to negotiate drug prices, could potentially reduce the long-term revenue potential for successful new drugs down the line.
What about interest rates?
Higher rates hit them in two main ways. First, valuation. Higher rates mean a higher discount rate in those DCF models we discussed, which lowers the calculated present value of those distant future cash flows.
Makes the future potential worth less today.
Right. And maybe even more crucially, higher rates make capital itself more expensive and scarcer. Investors become less willing to fund speculative, long-duration bets like early-stage biotech when safer returns are higher. This makes fundraising harder and potentially more dilutive for existing shareholders.
Okay, one more potential threat. Those U.S.-imposed tariffs from 2025. How might they affect Sista?
This is a hidden but potentially serious operational risk. That baseline 10% tariff on most imports. Well, biotech supply chains are incredibly globalized. Maybe 90% reliance on imports for critical materials?
So tariffs could increase manufacturing costs.
Yes, and potentially disrupt the supply of essential materials needed for their clinical trials.
Mm.
Finding and validating new, potentially domestic suppliers isn't quick. It could take over a year.
Which would be catastrophic for a company with only a year or so of cash left.
Exactly. It's another external pressure point they have to navigate.
Okay, we've covered a lot of ground. Let's try to synthesize all of this now in Chapter 7. Conclusion. It really feels like Sana is a study in contrasts, isn't it? Revolutionary potential versus some very significant near-term risks.
Absolutely. Let's summarize the bull case of the reasons you might invest. First, that revolutionary hypoimmune HIP platform, now with that crucial first human proof of concept.
The core science looks promising.
Second, they're targeting massive, multi-billion-dollar markets. Third, the management team is experienced, with a proven multi-billion-dollar exit under their belt.
The Juno reduction.
Fourth, they're backed by those sophisticated biotech VCs flagship, ARCH, whose continued investment signals strong expert conviction. And fifth, those recent, large, open market insider purchases at a price higher than the current market value. That's a strong signal.
Okay, that's a compelling bull case. Now, flip it. Summarize the bear case. Why might you avoid Sana?
Top of the list. Pre-revenue, high cash burn, limited financial runway into 2026. Entirely dependent on uncertain future financing.
The ticking clock is loud.
Second, that history of significant operational challenges, layoffs, strategic pivots. It raises questions about execution. Third, those class action lawsuits alleging a lack of transparency are a definite negative.
Trust and reputation matter.
Fourth, the pipeline is still early stage with an extremely high risk of failure. Fifth, intense competition from bigger, better-funded rivals. Sixth, high vulnerability to those macroeconomic headwinds, inflation, interest rates, and potential geopolitical risks like tariffs.
And finally,
That significant short interest. It shows deep market skepticism, a large group actively betting against success.
so you have these clear opposing arguments across their technology, financials, management, market, and valuation.
Exactly. It's a stark dichotomy.
And to reiterate the valuation summary, traditional metrics, pretty much useless here.
Right. The estimated intrinsic value range from educational DCF models is roughly $4 to $7 per share.
With the current price of $4.63 falling right inside that highly speculative range.
Which seems appropriate given the risk-reward profile. So the concluding outlook is pretty clear. Sana Biotechnology represents a classic binary investment.
Meaning?
If the hyperimmune platform keeps generating positive clinical data, if it leads to an approved product, the potential upside is truly immense, transformative even.
But the flip side.
Conversely, if the clinical trials fail, or if the company simply can't secure the necessary funding to continue, the potential for a complete or near-complete loss of capital is very, very real.
High risk, potentially high reward. The quintessential biotech gamble. Which leads us perfectly to our final provocative thought for you, the listener.
Considering Sana's truly audacious scientific goals on one hand and that precarious financial tightrope walk on the other, what single piece of new clinical data, maybe from the next phase of trials, or what shift in the global economic landscape, perhaps interest rates falling, or maybe a big partnership deal, what single thing do you think would most dramatically tip the scales in this company's future? Something to ponder.
Definitely something to think about. And if you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority deep dives on specific tickers. We're actually planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those.
And if there's a specific stock you're interested in, one maybe not in the S&P 500, and you'd like a one-off deep dive like this one, just drop us a super thanks on YouTube.
Absolutely. And the usual but important reminder. As always, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice.
Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.